Hello everyone and welcome to a new year. So my name is Matt. I'm the head of investment management at AJ Bell Investments, and I'm here to bring you a bit of a summary as to what we've done in the portfolios, how they've performed, how they all compare, and perhaps more importantly, how we see the year ahead and how we're positioning for that. As I say, so there we go. That's everything we'll be going through today. So for anyone who's a newer user of AJ Bell Investments, sort of last year was a very good year for us in terms of asset growth. So we launched in 2016, but we closed the AJ Bell financial year at the end of September with 2.2 billion. That was a fairly big increase from the year before, as we saw sort of flows of 1.2 billion over the year. We really aim to offer a choice to both advisors and direct customers via our UInvest platform by offering passively implemented solutions, active, a blend between them both, which we call our Pactive income solutions, and then more recently responsible solutions as well. What's probably important to note is that all those portfolios follow the same strategic asset allocation framework. So we really just aim to deliver sort of a consistent output, and actually the only difference really should be if you're using active funds or passive funds, but you should still get similar exposures to different regions, different bond types, no matter if that's passive or active. So we'll start off with the bit that people always care about, which is performance. So here we show the performance of the different ranges over a few different time frames. So we obviously sort of zone in onto the short-term performance. So that's the quarter. So it's the fourth quarter of last year. You can see there broadly sort of positive numbers. Those numbers are fairly strong in the context of what the portfolios look to deliver over a full year. And again, you can see that really play out into the 1 year numbers, where those numbers range from 4% to 15%, which under our sort of normal assumptions and as to what markets might do in the long term is a fairly strong sort of set of numbers. Typically our average expected return for our lowest risk portfolio each year is about 2.5%, and for our higher risk portfolio around 7%. So you can see it was a very strong market last year. You can then see again when you move on to those kind of longer time periods, so both 3 years and 5 years. So you can see on 3 years again, probably numbers ahead of expectations, really strong markets, strong conditions, even with the global pandemic. Whereas obviously when you move to that 5 year number, you can see as you get that longer time frame, you can see that the portfolios are doing exactly as we would expect to do. So really delivering that sort of good level of return or consistent return for the level of risk taken. Again, you can see for the income solutions, again, similar numbers to the growth solutions over the quarter and the year. Whereas on a longer term view, the income solutions have struggled a bit more, as income style investing has really struggled. If you think back to the pandemic when dividends were being cut, that really did hit quite hard income investors. We move across to our active portfolios. And again, what's pleasing to see here is that there's actually quite a lot of consistency between the passive portfolios and the active portfolios. We'll touch into why those performance does differ, but in general, you can see, for example, over the quarter, the active portfolios were just slightly behind the passive this time. But once you move on to those 3 year numbers, again, a consistency across both those active and passive portfolios. It's probably fair to say that for our lower risk portfolios, our passive portfolios have done slightly better. Whereas when we look at the higher risk portfolios, the active portfolios have really come into their own, benefiting from really strong positioning in emerging markets and Asia, where obviously the story of 2021, other than inflation, was around China, and having the managers in those regions who are able to navigate around those uncertain markets has really helped the active portfolios. And again, probably worth noting on the income portfolios, The active income portfolios have had a slightly better time of it compared to the passive income portfolios. There again, the use of active managers has allowed those managers to be in sectors and regions that have held up a little better, whereas the passive approach is a bit more broad brush across the board. And then, as you'd expect, our pactive portfolios or blended portfolios, the return ends up somewhere in between the two. Obviously, likewise, the cost of those of these solutions is again somewhere in between the two. So this is our way of sort of giving you a quick roundup of what's happening in the market. It's also there to help you understand, kind of how we might do versus peers, and we can also talk a little bit into how that means that different styles might perform. So I guess the big point here is you can see that equities have significantly outperformed bonds over the quarter. So that's why you see that nice shape of returns of, sort of low positive returns for the low risk portfolios, and that increases over the quarter. And obviously that's been the trend over the year as well. So you can see that nicely in the green, which is that kind of typical higher risk, higher return sort of point. Within our portfolios, we do invest for the long term, and as such, we do have a bias towards sort of emerging market equities. The reason for that is, in the long term, we would expect to see the performance of equity markets or stocks to mirror that of long-term economic growth. And as is fairly widespread knowledge, the likes of India and China, South Korea, etc., are all expected to grow at higher rates than Europe, UK, US. Obviously, in the short term, we know that emerging markets have struggled versus the likes of US. So again, it's really pleasing to see that our performance numbers are still strong, despite the fact that our emerging market bias has hindered performance over both the quarter and the year. One area that has worked well for us, we have had a preference for credit. In particular, we've had fairly large sort of weights in high yield bonds, and again you can see that high yield bonds have significantly outperformed government bonds over both the quarter and the year. So that is really sort of positive positioning there. So let's just have a quick whistle stop of the markets and what's happened. So as I mentioned, developed markets have done particularly well, and the US, which had a little bit of a wobble in Q3, bounced back really strongly in Q4 of 2021. The S&P was up over 10% in just the quarter. As I mentioned, emerging markets, Asia, lag. It's actually a really mixed picture in emerging markets. It's really China that's been dragging the markets down. Actually, when you look into it, areas like India, and as you know, we do have specific Indian exposure through both ETFs and active funds. India's done very well. Other areas, for example, Pakistan, we don't have direct exposure there, but Pakistan, again, another strong performing emerging market, whereas China has really struggled, and that's up to 50% of emerging market indices, so that's dragged down performance there. The quarter, I would say, was actually a bit of an outlier, and by that I mean, since the markets bottomed out in March 2020, what's the style that's really been in favour has been sort of small cap value, driven by a few different things. Obviously, first of all, the market bounced back, and then more recently the sort of inflation story really favouring that kind of value style, and obviously domestic companies as well. The quarter saw a reversal of that. As I mentioned, technology has done well, but what I've described as quality growth stocks have been the leaders again, and that does favour passive investing, because obviously if you think about, for example, the S&P 500, the 5 largest stocks dominate that index, and they're all sort of large cap tech stocks within there. So as I mentioned, passive had been slightly ahead of active over the quarter, and that was one of the big drivers. And then obviously credit spreads continue to tighten. We actually see a little scope for spreads going much tighter, and we'll touch on this later on in terms of how we're positioning the portfolios next year. One area I didn't mention was Japan. You can see Japan again has been caught up in that Asia EM sell-off. It had a good performance in Q3, so this is a bit of a reversal of that. So it has really been sort of punished. So it's not just emerging markets in Asia, it's also obviously the developed markets in Asia that have struggled. Again, we actually have a decent exposure to Japan, and the reason for that is Japan is a really good diversifier in the portfolios. You know, it does perform differently to your traditional developed markets, and obviously does the currency does particularly well in times of market sell-offs, but it is worth noting that, you know, it has had a tougher time. And as I mentioned, the two factors that have really worked: quality growth. So that's kind of a quarter for passive is probably the way to describe that. And you can see actually small cap stocks sort of did less well over the quarter this time. And then from a sector point of view, as you say, the previous winners are back up there again. The ones that we know have done well over the last decade, but maybe less so in the early parts of 2021. Technology's back up there. I guess perhaps more surprising is something like real estate and utilities. Again, they have actually benefited from sort of, you know, the interest rate environment and expectations as to what's going to happen around there. Energy sort of towards the bottom. I know obviously this review covers the fourth quarter, but as I recall this in January, you know, energy has bounced back strongly and obviously performed very well. So prior to that, so Q4 was just a little bit of a blip for energy, but again, in general, has done well on the back of that kind of reflation story, unlocking, and everything that goes with that. From a bond point of view, despite, for example, the Bank of England increasing rates over the quarter, it was actually the longer end of the bond curve that did a little bit better. But here we're not talking about big numbers, you know, kind of 0.2% return for the 10-year plus bonds, and, you know, a loss of around 1% for shorter dated bonds. So as I touched on, it's really been about having your credit exposure in your bonds with not much going on with sort of rates. So in summary, on the trends that affect both active and passive sort of growth MPS, as a modest positive performance over the quarter, strong numbers over 12 months and 3 years for both ranges. Passive outperformed active due to those kind of, I guess, stylistic trends rather than any issues with the managers we use. And despite our higher risk portfolios having a fairly big bias towards emerging markets in Asia, actually performance held up, and that was helped by us using different sectors. So, you know, for example, in that highest risk portfolio, have a decent allocation to either technology ETF in the passive, or the polar cap technology fund in the active portfolio. So that really helped sort of offset some of that Asia weakness that we saw. Riskier bonds such as high yield, you know, continue to help performance, given, you know, they do tend to be linked more to equity performance than bond performance. Again, we're cognizant of that going forward, so I'll talk about how we address that. And then, as you say, the use of sectors, again, broadly positive. You know, not all sectors we used did fantastically, but in general did better than average, and really helped that sort of robustness of return when it comes to the portfolios. If we want to look at a couple of the individual drivers in the active range, you can see that, you know, as I mentioned, despite emerging markets in Asia struggling, the actual funds we use there have done pretty well. So, you know, the likes of Jupiter Asian, which is, you know, quite defensive, sort of value in nature, and away from sort of those growthy areas, and JPM EM, which, you know, is underweight China, did fairly well. Again, you know, you look at in the UK, one of our active managers that had struggled in the earlier part of the year, Trojan. Again, it's a bit more of a defensive quality manager. Again, shows that sort of benefit of having different styles within your bucket. Did well. And then, as I mentioned, Allianz, we have a specialist manager on the active portfolios there, and continues to beat the market, and it's continued to beat the market on both upward and downward performing markets. So that's good to see. On the other side, Artemis has struggled. That kind of a bit of a reversal. So anyone who tuned into my Q3 webinar will notice I said that was well ahead. That has reversed. And then some of the sort of active sector calls compared to the ETFs just struggled a little bit again, because those active positions do have some exposure to both emerging markets and Asia. And then back to thinking about how we construct the portfolios, Troy did well. Tellworth, which is a small cap growth market manager, did less well. So obviously both of those managers are doing well in the long term, but you can see on a quarter basis how the performance of one does offset the performance of the others. If we move across to the income portfolios, as I mentioned, the active ones have got the lead here at the moment, outperforming the passive strategies. There's a couple of things that drive that. So in particular on the passive side, our US ETF there is significantly underweight to technology, and that was a bit of a sort of a headwind there. Whereas on the active side, we're able to just navigate sort of the current dividend versus dividend growth story a little bit better there compared to the passive portfolios. And again, on the other hand, when you look at the active portfolios, and in particular sort of look to the Asia positioning, you can see the defensive positioning there has worked well. And then the bond element of the active portfolios, the passive and active income portfolios is very similar to the growth ranges. So that's what's happened. What's going to happen next year, and what are we doing to address that? So I think the main themes within the market continue to be inflation. We had the UK print this morning, and the inflation for the full year last year is the highest level since 1992. And again, is that going to persist? Is it going to continue to rise? Are central banks going to react to that? So all these things that kind of go around that. And then obviously the other story is obviously around China. We're seeing lots and lots of money now flow into China and EM after a struggle last year. The question is, will that lead to a bounce back, or will that market continue to struggle? 1 year returns for all the portfolios are significantly ahead. And the reason I say that is I'm not trying to pat myself and the team on the back. What we're saying is, when you have periods of strong performance, we know in the long term what market's going to deliver. So strong performance can often lead to more muted performance in the future. So it's always worth bearing in mind that we have had a really good period, and returns might be a bit lower going forward. What we have done is on the 18th of January this year, 2022, we have updated our portfolios. I would say that last year we made really big changes to the portfolios because we had to reposition post all the sort of COVID shakeout. Whereas this year it's much more of a nudging of the portfolios, moving that dial to cover for that. I guess that inflation threat is the main one. So how, for example, are we thinking about inflation, and how are we thinking about it persisting? Well, there's two things we've done there. First of all, on the bond element of the portfolio, we look to shorten the average maturity of the portfolio. That doesn't make money, but it does mean that if rates increase significantly beyond expectations, that you'll lose less money. But it does still mean that you've got your bond element, which can do well in other types of crises. So political sell-offs, wars, that sort of market shakeout. So we've significantly shortened the maturity there. The other thing we've done is we've increased the credit quality. So as I mentioned, sort of high yield bonds, investment grade bonds have had stellar performance over the last few years. So there's less and less value in staying in that asset class, especially given they do link to sort of equity returns, and equities will probably sell off in the short term if inflation goes way above expectations. So by adding a bit more quality into that portfolio and also shortening the maturity, we think that gives us a better defensive positioning going into that risk of higher inflation. On the other hand, where we have overweights to Asia, EM, we've either maintained them or in some cases actually slightly increased them. Again, we think the sell-off in China in particular was overdone. Long-term growth expectations in that market have come down a little bit, but kind of actually not as much as the 30% sell-off we saw there. From a sector point of view, again, we've just done a little bit of rotation there. Back into the inflation theme. In the higher risk portfolios, we're introducing financials. Again, they tend to do well in a higher inflation, increasing rate, and the curve steepening environment. That comes, we're switching out of our consumer discretionary position there, which is more of a growthy position. So again, it's just a bit of a using those sectors to move the dial on our growth versus value tilt. In the low risk portfolios, we held a utilities position last year. Again, that performed well ahead of expectations. So we're essentially using it as an opportunity to, I guess the term there is to profit take, but it's more probably valuations have squeezed there significantly, and the continued use of utilities doesn't necessarily make sense within those portfolios. So that's a whistle-stop tour of performance and what we're doing. There is a separate piece that will be shared on Invest Centre covering those asset allocation changes in a bit more detail, but as I mentioned, it is really about just recalibrating, resetting. We're not making any major changes. The equity bond cash split, alternative split is unchanged, and it's just really within that allocation how we switch and how we allocate to different sectors and regions. We produce our quarterly reports, so they're all will all be up on the website as well, alongside, as I say, any updates we're making. So thanks for taking the time today to listen. Hope it was useful, and look forward to speaking to you again next quarter. Thank you very much.